I think it is 11 o'clock. So welcome everybody. A couple of bits of news to run through, and then we're going to be talking to James Dow, who's the manager of the Scottish American Investment Company, or Saints, as a lot of people call it. Thank you for tuning in. Obviously, we didn't know we had a guest last week, but we got it sort of organised last minute, and I'm quite interested to hear what James has got to say. But first, this bits of news. They both sort of happened earlier in the week, but International Biotechnology, the manager resigned, which is a very rare occurrence in the sector. And then Aberdeen Smaller Companies Income announced a kind of strategic review. We'll have to wait and see what's going to happen with that, but I've got a few ideas of what might happen to it. So, International Biotech first. The performance has been okay. I will show you that actually in a second. And it's tended to trade relatively close to asset value. I mean, there are periods here where the discount widens out a bit, but generally they're quite good at keeping it under control. And they've been doing a lot of that through buybacks, but also I think partly it's because the performance has been okay. Here it is against the rest of that sector. So you've got add-ons, which is a tiny little thing. And then it's sort of down towards the bottom end of the size-wise, but still 300 million, give or take, is not a bad size for a fund, and definitely sort of worth somebody picking up. Trading fairly close to asset value, as I say. And it's got this policy of paying out an income by sort of manufacturing it from capital. So that's based on the NAV and 4%. So that gives it a yield, which most of the others don't have, apart from Bellevue. And I say in terms of returns, as you can see there, over 10 years is actually one of the best performing funds in the sector. Not quite so high over 5. Really what's happened here, though, is that since the sort of COVID euphoria unwound, so when all these biotech companies were running around developing cures for COVID, a lot of money poured into the sector. That kind of went away again as that died down, and that's caused a sort of long slump for biotech companies. And so actually some people are saying they're looking quite cheap still. And so that's the reason why biotech growth and international biotech have been underperforming the sort of broader healthcare funds like Podacap and Bellevue and Worldwide Healthcare. IBT, though, as you can see more recently, has outperformed biotech growth by quite a bit, and that's largely down to a lot of stock-specific stuff that it's been doing. Hang on, I'm getting the wrong way now. Let's go back. There we go. There we go. So the manager is quitting to focus on its core healthcare business, which is basically the unlisted stuff. So they've got $2.2 billion worth of this. If they wanted to launch a fund, they probably could, because it would just be competing with the likes of RTW and Syncona. I don't see any reason why there shouldn't be a fund that's a sort of feeder into what they're doing in the private space. They've got a very big team working on it that they've built up over the years. But the public listed equities team is really just Elsa and Marek, which is probably, without the sort of support of the wider group, is probably too small for them to be carrying on purely by themselves. So for contrast, Biotech Growth's got a team of 12 just working in public equities, and then a much, much bigger team behind that. So I think what we're looking at is a sort of a fund looking for a home, 2 managers looking for a home. I guess it'll go as a package. And I guess it'll be picked up by somebody that's already got a kind of presence in healthcare already. Well, track records, I say, isn't too bad. They did have this guy, Carl Howard Jansen, who was the sort of leadership figure and actually sort of did all the kind of marketing and stuff until he stepped down in March 2021. So Elsa and Marek have been sort of picking up since then, though they were working on the fund for a long time before that. So I think there's a sort of continuity there. But actually, if you look at those 5-year numbers, they're not even ahead of the Nasdaq Biotech Index, the NBI. So they're not amazing. And you think that they are better than biotech growth. So the whole sector is slightly disappointing at the moment. And that's largely down to sort of stock specific influences. Their performance has picked up a bit, and actually these figures to the end of December, I think they would look better now because they've had a couple of big uplifts in the unquoted portfolio. So the bit the SV Health are running. So there was another sort of 7p a share of the NAV in the beginning of February. What they never really tell you is what companies are driving that. I always thought that's a real shame. So there's a real story to tell there if they would tell it, but they just run shy of actually giving you any information. And the other thing that helped them quite a lot is that they got bid for their biggest holding. Horizon Therapeutics was bid for by Amgen, and that was a big kind of uplift in the NAV. So I think, yes, we are looking for a new manager. The board are sort of not hinting that we're going to wind the fund up because they're saying they want to ensure the continuity of exposure to the sector. They've got really until February 2024 to get something sorted out, so there's no massive rush. But if they do find somebody suitable, then they can terminate the contract earlier than that. SV Health has agreed to carry on managing their unlisted portfolio, which totally makes sense. It's not huge, though, the context of the fund, so it's only 8% of it. That, I think, could be a bit bigger, but again, it's either you have a sort of dedicated SV Health fund or maybe you have a slightly bigger exposure to unquoted in here. There's definitely opportunity in that sort of area of what they're doing in biotech. Anyway, that's that. Having these smaller companies' income, I put here as a 10-year chart up, basically just to show you how long a period it's been since it was trading anywhere near a premium. So if you ignore the sort of weird bouncing and sort of falling bouncing markets and the beginning of the COVID thing there, we're going all the way back, probably until I think 2007. It's not very big, and as I've said many times, there are way too many funds in this sector. And I don't normally show you the whole table, but because it doesn't fit off the screen so well. But there are way too many funds here, and some kind of consolidation is definitely necessary, especially when you look at some of the ongoing charge ratios of these things. So it's good that this is being tackled. So performance-wise, again, this is a big table. It's quite hard to read there. It's been okay. It's not sort of standing out as being particularly awful in that sort of sector over 1 year. Still quite unexciting over 5 years. Not brilliant over 10 years. And I think it's largely that comes down to this sort of income bias that it's had, where obviously the sort of income side of things, the value side of things, has been underperforming growth. That's slightly complicated though, because they say that they're actually running a sort of quality growth portfolio, but with a yield. And actually, when you look at the numbers, they should have done better when the sort of value bounce happened, and they didn't. And I think that's because they've been, not quite in the sort of stocks that have been bouncing. Those are their numbers to the end of December. And you can see there that it underperformed over 5 years, over 3 years, over 1 year. So it's going to be quite hard to turn that around, and it makes sense that they are looking for a new alternative. It's been running since 1992, and as I said, it hasn't really traded at the same premium since 2007. It pays quarterly dividends with a yield about 3.6, which is okay-ish, not amazing for an income fund, but okay. But it is actually paying that from revenue, so it's not manufacturing that income. And so when we're looking for suitable partners, that's sort of got to be borne in mind, I think. It's got an element of fixed income in there to boost the yield, but that's actually quite tiny now. That has been bigger in the past. And it's something I suppose would yield on fixed income a bit higher than they were. They could be ramping that up. And that's something that one of the potential merger partners is doing too. So options. One that everybody's talking about is Shire's income, and there's a lot of logic to that. Shire's isn't big enough either. It yields more than ASCII and trades fairly close to asset value. The sort of killer is that it's already got a big stake in ASCII already, and they've already had some talks. So from that point of view, it looks like a sort of slam dunk. But I think what we're talking about here is basically you lose any kind of small cap element of the fund and just merge into the Shire's income, which should invest in slightly bigger stocks. It's also got the sort of fixed income equity blend to get the yield up. So they're going to have to find some more fixed income things to invest in. I think it is all doable, and you would get a yield uplift, presumably, and you get a discount narrowing. So a lot of ticks there, but I don't think necessarily it's the best option. One that sort of, I think, fits quite well is diverse income, which is a much bigger fund, so it's much easier for them to absorb ASCII. Yields a bit more than ASCII again trades on a relatively tight discount, and has quite a fair bit of small cap. Another small cap income fund is Chelverton UK Dividend. I think I'd like that to do that because I think that's too small as well. But I don't think it's doable because of the structure. So it's got 0 dividend preference shares, which does confuse everything. So basically, if they rolled the ASCII in without issuing more zeros, then the yield on the existing ordinaries would drop, and I think they wouldn't go for that. There's also the opportunity, I suppose, of merging it with the much bigger UK smaller companies fund, so just losing the yield element of it. So same management team, same sort of approach, but it doesn't actually trade on particularly tight discounts. So I think that might rule it out. One small cap fund that does trade quite close to asset value and does offer a yield, although it makes it out of capital, so distributing 1% of NAV each month, is Montanaro. And it's got the same kind of investment approach. So it might be quite a good fit. And then the simplest thing, I think, would probably be just to sort of fold it into one of the much bigger funds. So Lord Dev's Merchant City of London, they all trade at premiums. So you wouldn't necessarily have to have a cash exit. You could just have people selling shares in the market if they wanted to. They will offer a bit more in the way of yield. I think that might be a much simpler way of going about this. I suppose another opportunity might be to do a global equity income trust, which leads us neatly into our guest. I've been arguing for ages that there is a problem with trying to source income from the UK equity market, and makes a lot of sense to go looking for opportunities and the sort of much broader range of opportunities available in the global market. Time may make sense, but I think it's maybe just too big a leap to go from UK small cap income to global equity income. Maybe we'll see. Okay, so that's enough from me.